How is JP Morgan setting record profits at a time when banking is crazy and money's super expensive and it's stupid expensive? Well, I'll tell you guys, if you guys haven't been paying attention to what's happening on the market, ladies and gentlemen, I'll tell you, last week, JP Morgan came out and they stated that they had over $70 billion in excess. What happened with JP Morgan is this, ladies and gentlemen. One of the big things that's happened in banking is they're lending money in excess of the Federal Reserve rate. The Federal Reserve rate is sitting someplace between 4.8 and 5.1%. It's been volatile between there. Okay, that is what money should really cost. And JP Morgan just broke every record they've ever broken as far as profits. Their profits are in excess of 75% of what they were at this time last year. Crushing it, just breaking profits right now. And the way they've been able to do that is because in lieu of what's happening with banking and the appreciation of assets, one of the big things that's happened is that banks have been extremely conservative. They know that there's going to be a lot of foreclosures coming to the market. What's one of the biggest sectors of real estate that's getting plummeted right now? It's office right now. Office is so distressed since the pandemic that there has been so much vacancies that it's pulling and drawing down on the commercial asset sector. And so the banks know that. So when I talk to banks about lending, one of the big things that the banks come to me and said, they say, when I'm asking them about money, because I'm building assets right now. If you guys follow my content, you guys know that I'm building $30 million, $50 million, $60 million apartment complexes. And I go to the lenders and they're sitting back quoting me double-digit interest rates on construction money. And I'm sitting back scratching my head going, what the hell has changed? That we are seeing double-digit interest rates. And they're saying that the reason banks are charging in excess of what the Federal Reserve rate is because they're utilizing the spread of that profitability to offset their losses right now. And with retail being distressed for the last several years, it's offsetting retail and office being the two largest sectors that are getting hit right now. But they're not only getting hit with those two sectors, they're also getting hit with multifamily. And the reason that they're getting hit with multifamily and other commercial assets, including warehouse, including storage, including office, including all of those, is because investors, syndicators that are going in and giving up 70% of the asset to syndicate the property to their investors, they're giving up 70% of that equity to them. They're retaining 30% of it, okay? Now, a lot of syndicators expect to be out of that property and give an internal rate of return to their investors within 3 to 5 years, but most of them want to exit in 5 years. So if you're a syndicator and you promise your investors that they're going to be out in 5 years and you give them this preferred return and you retain a lower interest rate that gives more upside for the cash on cash return, meaning the money that you're paying month over month to your investors, the investors love it because they're sitting back going, damn, I'm getting more money than I would get in another investment. Because the interest rates are low and the cap rate is a little higher, you're able to give them larger returns, okay? But here's the caveat to all of that. So I always tell people, there's always a backside to that. Now, if you have a fixed mortgage, it's better because if you have a fixed rate mortgage, for 20 years, 30 years, you got time. And time is on your side. Nothing is better and greater than time. Because if you leverage time, then you have time to get out of that property, sell it at a low interest rate. But what happens, they do 5-1 arms, meaning that they do a 5-year call on the loan and then it becomes an adjustable rate mortgage. It's an arm, an adjustable rate mortgage. And so in 5 years, it goes up to what the market rate is. And so if the market rate is in excess of 7 or 8%, like it is today, and they had an interest rate of 3%, now they have a volatility of 4 to 5% variance in their rate, they're screwed. They're doubling what they're paying in interest. And so on these 5-1 arms, now the values of those properties drop, and so the banks won't refinance them. So they go into foreclosure. And so the lenders have been able to strategically position themselves to absorb some of that by being more profitable. Now, right now, today, what the profits that JP Morgan is showing are astronomical. they're in excess of, they're at 70% highs. They have billions of dollars in liquidity on the books, and they're sitting at a time when people and when money is expensive and people are leveraged to a T. They're screaming profitability, right? Now, will that hold long term? I don't know. And the caveat to it is that if we do land up seeing the foreclosures that we believe are coming to the market, and I believe that we still have at least 18 to 24 months of some of these foreclosures that are coming to the market, we're already seeing it because we're underwriting deals. You guys might not be seeing it because a lot of the big foreclosures never hit the market. They get sold off market. They go to people like me. They go to people that are students of ours, that we teach them how to get proximity to the right brokers, the right bankers, the right wholesalers, the right people that are giving these properties up in the market. And then we're able to go in and do either subject twos, if we want to assume the note and it makes sense to. If the note doesn't make sense to assume or take over subject to the existing terms, then we go in and we just buy it. And we buy it at a discounted price based on today's values, today's numbers. And so one of the big things with the banks is they're using that spread. That's their reasoning, is that they know that this is coming and they're going to offset their losses with their profits right now. So they're over leveraging the federal fund rate to be able to offset what they believe will be a liability coming in the up and coming year. Okay. Now we'll see how all that unfolds. But as of today, JP Morgan is friggin' crushing it. Because what they're doing is definitely doing what they were planning on doing. It's giving them more upside in returns. And this is also going to be, you're going to see this happening with all the large banks. JP Morgan, Chase is the first. You're going to see this with Merrill Lynch. You're going to see this with Goldman Sachs. You're going to see this along the big bank sectors. Okay. Now, are the small regional banks and community banks doing the same? That's the question. And my belief is that if they're smart, they're doing the same, and they should start being profitable as well. The banks that'll start hurting the most are the ones that are doing startup businesses. Banks like First Republic that went under. Banks that are investing in startup companies that have went under, because startups are a bad investment for banks, because startups don't make money, and the banks need deposits in order to make profits. So if a bank isn't high in depositories and a bank isn't high in lending with those deposits, then the bank is at a higher risk of default and lower profitability. A bank wants to have revenue coming in. They want deposits. So let me explain to you what happened with one of the banks that I'm dealing with right now on a local build that I'm doing. I went to a local lender, small community bank, and I said, would you guys be open-minded to or interested in investing in this loan for this $35 million development? And they said, well, you know, and they kind of huffed and puffed a little bit. They said, yes, we want it, Jerome. We know you. They've lent me money on retail buildings in prior years. And they said, yes, we'd want it. It hits a little higher than our threshold because we don't have a big threshold of $35 million. So we have to do it with our partner bank that's based out of Colorado. And I said, no problem. We can partner with your fathering bank that actually backs you guys. And then I asked them, I said, you know, we're looking at loans right now with 60 to 70% loan to cost to build our assets. Would you guys be willing to give us 75 to 80%? And they said, well, that's when they started huffing and puffing a little bit. They started squirming on me a little bit. And they go, well, Jerome, how much deposits are you going to give us? And I said, how much deposits are you willing to, do you have available? And I said, or how much deposits do you want from us? I asked them. And they said, they go, well, you know, what do you think is realistic and viable? And I said, well, if we house our interest reserve with you guys and some of our down payment money, let's say $5 million. And he got excited. He's like, oh my God, Jerome, yes, if you could put $5 million in depositories in our bank, oh my God, yes, I can talk to our underwriters, and yes, I can talk to our board of directors, and we can talk about getting you guys 75 to 80% loan to cost. And I was like, cool. Okay, so there's strategic ways to do this with some of the banks. Now, ladies and gentlemen, at a time where it seems that lending is friggin' crazy, it is, but there is an end to the madness, and money will start to stabilize. Someplace between 4.8 and 5.1%, because that's what the Federal Reserve fund rate is, and that's what's going to be the stabilization of money once the craziness of our market starts to plateau. Okay, but until then, if you want to be notified with content just like this, and other content that's investor and real estate related, and you want to build wealth in your life and passive income, then click and subscribe to our YouTube channel. Smash that thumbs up button if you like the content, and if you don't, give us a thumbs down and tell us what we need to do different. But otherwise, smash that thumbs up button, give us a little bit of love, and click and subscribe. Ladies and gentlemen, there is sun at the end of the rainbow. And I promise you guys that as we get into brighter seasons, as we move into 2024, money will become a little bit more reasonable, and you should be shopping and you should be underwriting deals right now. And if you're not, you're doing yourself a disservice. And you should also be buying deals right now. Because even though money's expensive, the cost of acquisition is extremely low. And when the cost of acquisition is extremely low, the debt service and the variance of the debt service that you might pay a premium on today is going to be a small marginal variance in comparison to your equity spread of profits long term. Don't cost yourself a long-term opportunity based on a short-term, small mindset. Invest today and always understand that it's important not only to compound your money, but to compound your success. Click and subscribe, pound that thumbs up button, and we'll see you next time. God bless you all, and go out and compound your success.